Hi there, David's here from Critical Trading. Hope everyone's keeping well. In today's video, I'm going to share with you a very interesting market anomaly that I discovered recently, and that is the size of the overnight moves in the stock market, specifically in the E-mini Nasdaq futures. Now, I've been doing quite a lot of research recently into trading the overnight movements in the E-mini futures, and I have come across a very interesting kind of pattern that the overnight moves have been getting more significant recently. So let me show you what I mean first. I've got a chart of E-mini Nasdaq shown on the screen, and the price chart only shows the day session, so the regular trading session of the E-mini Nasdaq futures. We can observe that sometimes the gap in between the close and the subsequent open of the following regular trading session is quite significant. So let's have a look at some numbers. I've got an extract from my Python analysis that I did on this, and what we can see here is data that shows a year starting from year 2010 up to the year of 2020, and then I have an average overnight move, and this is a percentage, and we can see that in 2020 the average overnight move is pretty much double that of 2019. So I was wondering, is there any way we can kind of capitalize on this and trade this? Let's have a look at how that may look like. What I'm going to share here is a simple volatility breakout strategy in E-mini futures. Now, this is nothing new, but depending on how long have you been interested in systematic trading, you may or may not have heard about this kind of strategy. And basically what it does is it waits to establish today's open, and then it trades its breakout as long as the current price breaks a certain level above the open. So the rule number one is that we want today's open to be greater than yesterday's close. Okay, so we want the overnight gap that I just spoke about. So we have the overnight gap here. So that's our rule number one. And then what we want to do, we want to wait to see that the current price today exceeds a certain level, and that certain level can be calculated using various approaches. You can start with something like the ATR, which is the indicator that measures the volatility of the market, and you can take a certain multiple of the ATR and add it to the opening price. So your breakout level would be somewhere here, for example. So this is rule number two. You want the current price to exceed the breakout level, and then when that happens, you buy at that breakout level. You can do this using stop order, so buy stop order, which is widely available in any trading platform. And then what you do, you close the trade at close of that trading session. So that would be number three here. Very, very simple strategy. This is commonly known as a volatility breakout type of strategy. And if you haven't heard of it before, I highly, highly recommend that you start experimenting with it. You can take these rules that I've just given you and try to code it yourself. Alternatively, I have coded it myself here, and we can see the backtest results on the screen. So again, this is the E-mini Nasdaq futures. This backtest was done on 2 years, 2020 and 2021. We can see that the number of trades is 161. Again, these are the setups that I have just described on the previous screen. And we can see that this strategy has got a very, very nice profitability to drawdown ratio. Bear in mind that I only tested with one futures contract, so these numbers are without compounding, and then this is the equity curve covering the period of these 2 years. Now, there aren't many conclusions that we can possibly make of, testing the strategy on 2 years worth of data. It's simply not enough, but over this period I'm looking at here, strategy definitely shows an edge. But now remember what I said in the beginning of this video. There has been an increase in the overnight moves, and the reason why I started testing this strategy was because I discovered that the overnight moves are getting bigger, and so I wanted to test a simple kind of logic of what happens if we use this strategy, but instead of exiting at close, we hold the trades overnight. So let's test that. If I then look at the backtest results, the average profit and loss went up significantly to over $400 from about 170, so a very, very significant improvement. And let's have a look at the equity curve, and we can see that it visually looks much, much better than the previous one, just by changing this one simple rule of holding the positions overnight. So is this guaranteed to work forward? What if the overnight moves start to get smaller and smaller again? Well, then this strategy is not going to work that well. But again, this was just to show you how a simple rule change in your strategies can make a big, big difference. So hopefully you found this valuable and it's something that you can use in your own trading. Thanks for watching. David at Critical Trading signing out.